Welcome back. I'm Sinead, defense economist and investor.
And I'm Alex, technology and finance writer. So, Sinead, what's been on your mind this week?
So, apart from our obviously very exciting podcast topic of conversation today, I have been thinking a lot about, in my work world, the SpaceX Starship program, which I don't know how much people actually follow this in the real world. In my world, it takes up a lot of oxygen, but the program has slowed down. I think it's moving beyond just technical speed bumps and is not super successful in terms of its launch and engineering cadence. So that's probably one of the bigger topics of conversation alongside the normal Elon Musk shenanigans.
Based on the very informed world that is my Twitter feed, it sounds like Elon is on the down and Bezos is on the up.
Yeah, it's interesting because, look, I would say Bezos is on the up. Maybe he's just no longer below Elon. Trump tweeted recently, talk of deporting him back to South Africa. Yeah, I think engineering-wise, Elon is not having a good quarter. Politics-wise, I think you could probably say the same. I don't know, what outside of this, my view of this is obviously tainted by the fact that I do a lot of work with Blue Origin and, Bezos lives in my orbit. But what is the out of the space industry perspective on Jeff?
Honestly, I've genuinely, this is the first time in about, since that slightly cringe launch a few weeks ago that I've seen Blue Origin kind of mentioned at all.
Okay. Apart from his wedding. You probably don't follow the gossip as we know, but he's been in the news a lot because of this multi-$100 million wedding of his.
Wait, I thought he'd already gotten married. Has he got married?
Yeah. Well, very recently.
Good for him.
We live in completely different worlds. So it's kind of, I think one of the big things around that is we're all kind of separating our recycling, the plastics from the paper for the recycling bin. Meanwhile, 100 private jets flew into Venice for his wedding. So we're, it's Jeff Bezos' world. We just happen to live in it.
On that cheery note of a small handful of companies apparently doing very, very well while the rest of us sort of plod along, I think we're going to talk about the S&P 500 this week.
Yeah, this is something that we have obviously, you and I, Alex, talked about a lot recently. And I'm excited to do an episode on this because it brings together some of our favorite topics. But yeah, basically the S&P 500 just hit, this kind of all-time high. It'll probably do this 10,000 more times before we even put this episode out. It's really soaring.
Which is odd because maybe I'm being overly influenced by living in the declining United Kingdom, but people do seem intensely gloomy about their own economic position.
Yeah. It does feel really dissonant. Modern economic history has not kind of showed this difference between the haves and the have-nots in such extreme ways. But, Wall Street is obviously this kind of crazy euphoric high. Well, parts of it are. And regular people are kind of we've talked a lot about credit card debt on the show before and real wages not really moving and no hope of buying a house and the whole avocado and toast conversation, it continues.
Yeah, so I guess the question we're asking today is what the hell is going on and why are markets booming while people feel like they're drowning?
Yeah, and again, a mix of our favorite conversations. We're going to talk about the Fed put, old people, of course, which dominate every conversation, and how pensions are secretly functioning like Ponzi schemes, and why passive flows are distorting pretty much everything in the markets, and kind of leading to why the S&P basically boils down to 7 tech companies.
Right, let's dive in.
So to be blunt, the S&P 500, as I said, hitting all-time highs. NASDAQ is flying, headlines euphoric, kind of soft landing. The fact that we're still talking about any landing, this kind of resilient economy, and we're back to a bull market. When I talk to people, the reaction to that is really mixed. Some people are doing better than okay, and others are definitely not. So some people emotionally, financially, existentially are just feeling the burn. They're exhausted, over leveraged. So many people I know defaulting on something, whether it's student debt, mortgage, whatever.
So I thought all your friends were rich and famous. How are they defaulting on their student debt?
Alex, I'm friends with you.
I'm definitely not. Okay, I'm not over leveraged. My leverage is 0x.
I'm not saying you're one of these defaulters. I'm just saying you're not rich or famous.
Ouch. Well, we have this,
we have this podcast now, so we are substantially closer to rich and famous today than we were a month ago. But it's true, right? Credit card debt has just hit 1.3 trillion with a T dollars, and that's the kind of the highest it's ever been. Delinquencies are rising fast, especially among younger borrowers. Student loan repayments in the US it's more relevant for the US and here, just, have restarted auto loan defaults, a massive one in kind of the economics world. They're now at levels we haven't seen since 2008. So basically, the question is, how can Wall Street be celebrating while Main Street is really suffocating?
Yes, it does feel like a textbook split screen. So yeah, you've got on the one side these record high markets, record low volatility, although that feels a bit shaky, and a financial media class who sort of are treating this like a victory lap for US capitalism, if through gritted teeth in some cases. And on the other hand, working people trying to figure out how to pay rent, split a Netflix account 6 ways, or side hustle their way to a dental appointment. And you can't just blame vibes or narrative here, but this is material. Real wages have barely budged. The personal savings rate has cratered to 3.8%, which is down from 9% pre-COVID. Rent is eating up 40 to 50% of income in most major cities. The kind of worst of the 2022 era inflation has abated. Like grocery prices never came back down.
I mean, this is so insane that people think prices ever go down. But yeah, like basically that gap, this kind of total cognitive dissonance between the markets and reality. Honest to God, I feel like I'm going crazy because no one talks about it. It's supposed to be a recovery, right? Like the Fed paused rate hikes. AI is the future. We are fully now in AI universe. Tech stocks obviously booming. Anything that's AI adjacent is booming. And yeah, the job market looks unbelievably strong. But yeah, we've talked about her before in the show. Kayla Scanlon coined the term vibesession for a reason. And that data is fine technically, but like the human experience is in, kind of crisis mode. People are exhausted from holding it all together and this kind of constant erosion of the basics like safety, stability, mobility. You can't tell someone staring at a 600-pound energy bill that the growth is solid and kind of expect them to say, oh, great, thank you. We're so delighted that the S&P is doing its best.
I mean, you can. It was called Kamala Harris's presidential campaign. But but yeah.
So true, by the way. So true.
But yeah, so I think the question we're going to try and answer today is, if most people are worse off than they were 2 years ago, why is the market still going up? Because obviously it's not retail, it's not your neighbor, it's not the consumer, as economists love to say. It's capital, specifically big capital, circulating through a closed loop of passive flows, policy signals, and forced buying.
Yeah. And, long story short, here's the answer to all of this, although we're going to get into the finer details. But the market is not reacting to the real economy. When we talk about the S&P being an all-time high, it's reacting to the expectation that the Fed won't let it fail. It's also reacting to pension funds that have no choice but to keep buying equities. And it's reacting, obviously, to momentum because passive investing doesn't kind of stop to ask, like, oh, should this keep going up? It just keeps buying what's already winning, which is obviously the S&P 500.
So yeah, if people are wondering why the S&P 500 feels disconnected from actual life, it's because it is. It just isn't a mirror of the economy. It's a rigged casino where the house seemingly has infinite chips.
Yeah. And so let's look at who's holding the rig and who's supplying the chips. And Alex, I want to talk about our favorite topic, the Fed.
Yes. So the Federal Reserve is the dealer behind the table. And basically the reason the market keeps soaring while the economy flatlines is it comes down to the fact that everyone believes that the Fed won't let it fail. And this is what's called the Fed put. It's not a law, it's not an official policy, but it's baked into every institutional model, every hedge fund strategy, every pension asset allocation, which is if things get bad, the Fed will step in because if you look back pretty consistently, 2007, 2008 onwards, that's what it's always done. But that's a long way from what the Fed is supposed to do. Officially, the Fed has a dual mandate, which is keep inflation stable and maximize employment. That is it. It's not supposed to prop up the stock market. It's not supposed to ensure constant asset price growth. It's not supposed to be a full-time hype man for the S&P 500. And yet here we are, because after 15 years of crisis response playbooks, whether it was 2008, the Eurozone crisis, COVID, bailing out those clowns at Silicon Valley Bank and the regional banking panic, the Fed has quietly picked up a third mandate, which is don't let the markets freak out. And obviously, once that expectation is in place, it rewires everything because investors just stop pricing risk. They stop pricing rescue. Investment stops being a bet on company performance and instead turns into a bet on Jerome Powell's threshold for pain.
You saw this so clearly also with Silicon Valley Bank, or as Alex, you call them, those clowns. 100%. This wasn't some too big to fail colossus. Really, it wasn't. This was not Lehman Brothers 2.0. Quite the opposite. It was a mid-sized tech bank run by guys who made basic, dumb duration bets. And, by that I really mean borrowing short, lending long, and hoping rates would stay near zero forever. I mean, this was classic WeWork. And then when they didn't, when rates obviously rose and venture capitalists started panicking in the group chat, quite literally. The whole thing unraveled in 36 hours. I remember at the time writing for the Financial Times, and it was just absolutely manic. I just left dinner. Where was I? In Dublin. I'd left dinner, looked at my phone, and thought, oh my God, here we go. And it was a crazy week.
I was in the UK VC Silicon Valley Bank WhatsApp group chat. So
no,
yeah,
you weren't.
I was. I get the vibe.
Screenshots.
Yeah, I'm not going to do that, but I get the sense is that obviously I think everyone was congratulating themselves on doing a great job, but I think the government had basically made up its mind already. But there was a lot of very, very intense displacement activity going on.
Oh my God. Well, yeah, I mean, I heard in the US at least a lot about it from primary and secondary sources. But basically within a weekend, it really was the most manic 48 hours ever. The Fed and the Treasury came in with a full-scale deposit backstop. I mean, this is not just for insured accounts, for literally everything, unlimited, retroactive, no vote, no congressional debate, and no public discussion of moral hazard because, Jason Kulkanis screamed even louder than public debate could be heard. And that kind of moment, that exact move sent this super loud, very clear signal to markets, which was, even if you're reckless, even if you're niche, you will not be allowed to fail. In fact, it nearly helps you to be well-networked and rich and loud and dumb. And here's where it really echoes 2008, because we were told back then that bailing out the banks was a one-time emergency and it's kind of system-saving intervention and never again. I'm sorry, but Silicon Valley Bank proved that the playbook wasn't retired at all. In fact, it was actually refined and faster and cleaner. This bailout happened way faster than 2008. And this is what moral hazard actually looks like now. So it's not some abstract econ textbook idea. It's very much this kind of real thing where people who take the most risk get the most protection, not the most downside, which is what it used to be. And that the people who play it safe, the ones with no assets, no leverage, no insider access, which is not us because Alex is in all the cool group chats. Yeah, they just get to eat the fallout. I mean, I'm not a socialist, but this does drive me crazy. This is just bad investing.
It is. I mean, and with Silicon Valley Bank, it was just bad corporate treasury management. It's not even that complicated. And the irritating thing is it was framed as, saving these innovative companies. There were plenty of actors who were prepared to step in and just basically buy out the depositors at 70, 80 cents on the dollar. So they would have taken a haircut, which would have served them right for being shit at their jobs. But the idea that all these poor innocent startups would have been left with I always loved it was always the innovation economy. It was always the kind of Silicon Valley Bank cliche, as if they're going to be left with nothing was total bollocks. And
we would have totally died if we didn't have those fucking grocery delivery companies.
Yeah, it was, as you say, it was a bailout for the elite dressed up very unconvincingly as system stability. And yeah, of course, Wall Street heard the message loud and clear. We've got your bank. And I said we've got your bank. I meant we've got your back. Freudian slip. And, I mean, it was a great opportunity. Yeah, it was a great opportunity for dip buying in regional bank stocks. But yeah, so what happened? NASDAQ soared, risk on again, rally resumed.
Totally. And a friend of mine actually, and so just to show that this thinking is not just in the kind of banking sector, a friend of mine actually told me not so long ago with a totally straight face. So she is not involved in finance or investing or anything like that. She said to borrow as much money as humanly possible because it's basically free money. Now she is over leveraged to an extent, I don't even want to talk about. Her friends are all over leverage. I mean, this is a common thing. She has been told, and she believes that you should really borrow more than you can afford to because it's free money. Okay. Now, she doesn't understand the mechanism really, I suspect, as to why that is. And you kind of think, well, this is not just free money. Obviously, leverage comes at a price. But directionally, she was actually accidentally right, because in the UK, if you bought property and just kind of held on to it, it didn't matter how overstretched you were, you won. So like even when interest rates rose, mortgage holders did not get wiped out. They were bailed out quietly with targeted support, interest-only extensions, a lot of political pressure in the UK on banks not to force repossessions. And they were way too scared to touch the real estate market, because if prices actually fell, it would threaten the only wealth system in the UK kind of still believes in. This idea of a lack of moral hazard goes far beyond the Silicon Valley banks of the world and is now kind of entered into the retail consumer space where, yeah, the government, if it's not the Fed, the government will bail us out anyway.
Yeah, I mean, this is what happens if you live in somewhere like the UK, where law one of politics is house prices are never allowed to go down. And in a world like this, prudence is punished. If you rent, if you save, if you wait, you're priced out forever. But if you lever up early, the system will probably make sure you land on your feet because, yeah, heaven forfend the property ladder ever tilts.
Right. And so when we look at the S&P kind of hitting record highs or UK house prices holding despite economic chaos, the question really is not why. It's rather who is being protected. And yeah, it's always the same answer: the people with assets.
Yes, because yes, there's like another layer here behind the never-ending market highs, which is the pension system, because behind a huge chunk of this market strength is a buyer that has no choice. And well, specifically US pension funds, less so in the UK, have to keep buying stocks whether they want to or not, because while everyone's screaming about inflation and recession, this massive institutional buyer, pension funds, just keeps buying.
Yeah, I like to blame old people for like nearly literally everything, but it's true. The pensions are the biggest price insensitive buyers in the system. So take CalPERS, for example. This is the California Public Employee System, an LP in many, many people's funds that I know. They manage over $450 billion, like billion with a B, and that's not unique. Global pensions manage over $56 trillion in assets, most of it heavily tilted to equities. I think it's like 40 to 50% of that is invested into equities. Why is this, Alex? Well, because they are now chasing 7 to 8% annual returns year after year just to meet their payout obligations. So, you put your money in, they invest it for you, you get old and you want that money back. They got to give that money back to people, but they've spent it on investments. So 7 to 8% in annual returns used to be kind of easy for them to make when interest rates were zero. Spoiler alert, you can't get that from purely investing in bonds anymore, which is kind of what they used to do. So now they're forced to keep doubling down on equities like the S&P 500, regardless of the valuation of the companies in them.
And this becomes a kind of feedback loop because, yeah, retirees need payouts, pension needs grow, pensions buy equities, equities go up. This validates the strategy. Wow, just always buying works so well. So they just, rinse and repeat. And the system only works as long as more people keep paying in. And that's where the whole thing starts to wobble because globally, we're arguably beginning to run out of people.
Yeah, I wrote about this years ago. Like, we need to start making more babies. Like, promiscuity is the pension industry's friend. I mean, birth rates have completely collapsed. I don't know, like the US fertility rate is, it's well under what it needs to be, but I think it's like 1.6-ish. A record low. In the UK, it's even lower than that. I think it's like 1.5. So basically, every developed country is below replacement level. And then at the same time, you've got this aging population. And the OECD dependency ratio, that's kind of the retirees to working age people, which is an increasingly important number when you think about public sector economy, is set to double by 2050. So Japan, South Korea, Germany, they're already staring down 1-to-1 ratios. So you've got fewer people working, fewer people contributing, and more people pulling cash out. Yeah, that's really not so much a retirement system. This is, and I've used this before and people got angry when I say it, but how the hell is this not a Ponzi structure? It is propped up by demographic momentum that doesn't exist anymore.
Yeah, and a Ponzi scheme collapses when the new money stops flowing, and pensioners are sort of still pretending they'll get historic equity returns forever. But what happens when boomers start withdrawing in mass and younger generations who are poorer, more indebted, and lower earning can't replace the inflows?
Exactly. And this is where Minsky comes in. So remember Hyman Minsky? I don't know if this name is known outside of economist circles, but
It's not.
Okay, excellent. He laid out the idea that financial systems kind of become unstable precisely because people think they're stable. I mean, this really is back in the day when you could become this like Nobel Prize winning economist by having thoughts. Anyway, right now, pensions are betting on stability, on this kind of endless growth, endless contributions, and this kind of endless returns. But that very bet is what is making the whole structure fragile.
Yes, and it gets darker because while we're helping to prop this up through taxes, labor, and consumption, future generations are not going to get the same deal. People in their 20s and 30s are told to invest early, think long term, trust the system, but they're doing that while buying assets at peak prices, supporting legacy payouts, and shouldering the risk of a future that won't protect them back. And that's the worst part, is that pensions are inflating asset prices today to fulfill promises that won't be kept tomorrow. And at some point, the music will have to stop. I mean, if like me follow a lot of like libertarian finance bloggers, the music is meant to have stopped about 25 times in the last 2, 3 years, yet it continues to keep going. But, what happens when pensions have to sell to meet obligations and there's no one left to buy? That will not be a small market correction. The market will crack because this wonderful self-fulfilling cycle wasn't designed for demographic decline. It was built for exponential growth, and that era is over.
But man, we are seeing this play out in real time in Ireland. I'm on the board of a public sector organization. And, the public sector in Ireland, precisely for this issue, is struggling. So in Ireland, we run a kind of pay as you go system, which means current workers' taxes fund today's retiree pensions. But here's the problem: the public sector pensions already cost over 4 billion euros per year. And that number is obviously projected to more than double by 2050 because, old people. And Ireland's over 65 population is nearly going to triple by then from, I think, like roughly 700,000 to over 1.5 million. At the same time, the workforce is barely growing. Fertility rates are below replacement, and thousands of young workers, especially in healthcare and education, are emigrating because, unsurprisingly, they cannot afford housing or kind of basic stability. So yeah, you've got fewer people contributing, more people withdrawing, and pension obligations that are entirely unfunded because, yeah, there's no pension fund. It's all on the state balance sheet.
Which, yeah, means presumably it's all being paid out of tax revenue, which is also supposed to be funding hospitals, schools, climate stuff. And so, yeah, this future is being cannibalized to pay for these past obligations.
Exactly. And obviously, no one wants to touch it politically because public sector pensions are seen as sacred in Ireland, especially for older voters. I mean, the same is true in France. I was in Bordeaux on a lovely wine trip when I got stuck in, a couple of years ago in these crazy pension reformation protest. Feels like, I think it was more of a riot, honestly, but it's the same thing in Ireland. So instead of reforming the system, we just kind of protect the illusion. We tell the 27-year-olds to max out their pension contributions. And, the reality is that we know those funds won't be solvent when these same people are 67. So again, it's just not a healthy system. It's super fragile. And the longer we pretend it's stable, the worse the eventual adjustment becomes because, yeah, we're not investing in our future for the people, my age or younger. We're actually subsidizing someone's present, and that someone is old, very rich, and probably very happy with their lot.
Yeah. I mean, I'd love to passively benefit from asset price inflation produced by bad policy. Someone make that happen for me. It sounds great. But yeah, so we've talked about the Fed backstopping markets. We've talked about pensions inflating prices just to delay collapse. But there's a force that ties all of this together, which is arguably the most powerful, and that is passive flows. Passive flows are what happens when capital moves into index tracking vehicles like exchange traded funds and mutual funds that mirror the S&P 500, NASDAQ, or other benchmarks. They don't make active decisions. They just buy whatever the index tells them to in proportion to market cap. So I think it's actually something a lot of people don't realize is that when money flows into an S&P 500 tracker, it doesn't go equally to the 500 companies in it. It goes mostly to the biggest, which, Apple, Microsoft, Nvidia, Amazon, because they make up the largest weightings. And this creates a subtle but deeply distorting force because the bigger you are, the more flows you get, regardless of valuation, performance, or risk.
And this isn't just some quirky byproduct of indexing. There's some great index economists and writers, by the way. I'll link to them in the show notes. And it's kind of this total transformation of how markets function today versus, I guess, how they were originally created to function. Is this kind of very famous physicist and market theorist. And I'm not only saying he's super famous because I run his Substack, although he is super famous. Jean-Philippe Bouchard has shown markets today are increasingly governed by these kind of endogenous dynamic systems. So that kind of means that prices are driven not by new information, not by some, crazy audit report that comes out and says the whole company is a sham, but by the flows themselves. And, it's not the earnings or the news that moves prices anymore. It's the active trading, especially when it's passive, automated, and done at kind of massive scale. And Alex, this is kind of why we talk about these great short selling ideas all the time, and then we're like, oh fuck, there's no point because prices don't go down. So JP Bouchard calls it reflexivity without feedback. This kind of closed loop where buying leads to more buying. And no one's asking whether the price makes sense anymore. And this is how you get momentum instead of valuation. Not this kind of well-functioned market, just this endlessly fed machine.
Well, yeah, I mean, this is actually in many ways, I know this is a bit of a side point, where you kind of look at the Wall Street Bets guys on Reddit or like the meme coin traders. And on one level, there's something quite like nihilistic about how they literally don't care about the assets they're investing in and whether they're like total shit or not. It is, they actually get this better than many economists. They realize it is purely like momentum is all that matters, and they are, if somewhat cringely, like acting rationally, they get this kind of like broken system.
Sorry, but for sure.
Now.
I mean, it is not at all surprising that a meme Twitter account gets us better than economists, because I mean, I live in the world of economists, especially market economists, and they all kind of talk about the same stuff endlessly about how markets are supposed to work. And, that's great. And they talk a lot about what should happen because that makes sense for them mathematically. They can still publish their papers because the math works out. But the reality, as JP Bouchard says, is so different to that. Markets don't work in the way that they were designed to work. They work in how we have made them work. And that is literally how these Wall Street, kind of meme investors understand them to work. And sometimes I think that we're morons for thinking too much about this.
Yeah, I mean, this all kind of maps a bit onto, George Soros, very much the thinking man's hedge fund manager, and his theory of reflexivity, which is, price rises attract flows, flows push prices higher, momentum attracts even more flows. And when those flows are price insensitive, as passive funds are, the feedback loop gets stronger, which this essentially takes the market's core function, which is price discovery, shoots it in the back of the fucking head and replaces it with a kind of algorithmic mimicry. And, capital just doesn't go where it's most productive. It goes where it's already concentrated.
And this is quite literally how we ended up with the Magnificent Seven dominating the S&P. At the time of recording, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, kind of make up over 30% of the index's entire market cap. So yeah, when you buy the market, you're not getting, as Alex, you said, the 500 companies, you're getting 7 plus like 493. Is that right? Yeah, the 500 minus 7, 493 that barely.
Your economics expertise really shining through.
See, I'm a good economist. I can subtract numbers.
Yeah, I mean, if you look at like the median company in the S&P, like it's not gained in any. It's not gained. In fact, I feel like is it true? Like the majority have actually lost value.
Yes,
if you go back. But yeah,
absolutely they have.
Which means that the S&P is a tech momentum fund, not a diversified index. So if you look at those fancy metrics that economists like Sinead like Sharpe ratios or standard deviation, they look healthy on the surface, but that's because they're propped up by the concentration at the top, and this hides the tail risk and the fragility.
Yeah, and that metric, the Sharpe ratio, used to be something that investors cared about too, but not anymore, I guess.
I was going to say I'm more of a Shiller PE ratio kind of man, and that's actually it's all fucked on that metric.
Well, we're going to get to PE ratios too. But passive funds don't rebalance based on performance. So that, it's not like someone's sitting there at a pension fund being like, did Tesla just commit fraud on their latest quarter report? Should we like pull back a little bit on that? Will the price go down? No. Not at all. They don't punish bad management. They don't vote. They don't sell. They are literally just sitting there. And, this is how they kind of reward, or, we as the market rewards index inclusion. In the most literal version of Goodhart's law, which says when a measure becomes a target, it ceases to be a good measure. So yeah, once you're in the S&P, the capital comes pretty automatically, not because you earned it, obviously, just because you're large enough to kind of trap the global inflow of the market economy.
Yeah. I mean, that's why when companies miss earnings or issue profit warnings, the index can still rise anyway, because the flows are mechanical, they're not analytical or event driven.
From the outside, it creates this illusion of prosperity, and this is where my mind is so blown right now, right? Because the headlines say the market is up, but what they actually mean is Nvidia is up 12%. Meanwhile, the Russell 2000, America's small cap index, and I'm surprised we didn't hear more about, by the way, the Russell 2000 during the recent presidential election campaign. I mean, we heard a lot about from Wall Street to Main Street, but really the Russell 2000 is what we should have been talking about more frequently. Trump conveniently forgot it existed and focused on the S&P. But yeah, this is America's small cap index. It is down or flat, as we kind of talked about. The equal weight S&P, as Alex, we just mentioned, it is underperforming massively. But, we pretend everything is fine because this tiny corner of the global financial market is eating all the inflows.
Yeah, during the kind of market surge before Trump came to power, I got nervous and started investing in an equal weight S&P ETF. One of the worst investment decisions I've made recently. That was really dumb. I should have
say, every single time that you mention on this podcast about one of your investments, it's a horrible investment.
Okay, yeah.
We're gonna have to sprinkle in some good ones there so people don't think that you're really shit at this.
There have been some good ones, but I don't like to brag.
So very British of you.
Anyway, underlying all of this is the danger is that passive flows don't reverse gradually, and they reverse all at once, because if index selling is very, very highly likely to be correlated, because there'll be a massive sentiment shift and everyone will panic. And when everyone's holding the same 7 stocks, either directly or indirectly, and those 7 stocks are holding the market up, Atlas holding the sky on his shoulders, and everyone runs for the exit at the same time, it's carnage.
In the field of economics, this is really what I look at, these kind of complex systems and how they become so fragile. And this is exactly what you've mentioned, just exhibiting this insane systemic fragility. And it looks really good and it sounds like it's doing really well until one day it isn't. I mean, it's very binary. And when it breaks, it's not like, shit, we're going to have a small correction now. It reprices everything that was kind of artificially inflated by autopilot capital. And repricing, by the way, is not a neutral word in the world of finance or economics. It means that when you hear the word repricing in a quarterly report of a company that you've invested in, it means you're fucked, basically.
Yes. I mean, the one I always like is when a company's been underperforming for a long time, or or an investment trust, is it always goes we are waiting for them, we've got to keep holding until the market re-rates us, which is always clue for the shit we hold is never going to become more valuable. We're fucked. But it's always the re-rating is coming. But yeah, we've actually seen this before, because there was this hedge fund that was briefly the smart money, which was long-term capital management, which became very famous in the 90s. And, it was this fund filled with PhDs and Nobel laureates and the guys who'd invented the options pricing formula, and they were armed with models and leverage. I think they were 10, 20x leverage, because they believed through their very clever maths they'd calculated these risk-neutral positions. I think it was an earthquake in Russia or some shit like that in 1998, basically caused the entire thing to collapse, because everyone was on the same side of the trade and liquidity just vanished. And the Fed had to step in and coordinate a multi-billion-dollar bailout, not to save LTCM, which they still sort of did for a while. It kind of carried on in this sort of husk-like form, but to save the system from it. And the scale is now bigger. The entire market is a version of LTCM, crowded and one directional and built on the assumption that someone will step in if things go wrong.
Right. I have so many thoughts on the LTCM explosion. All I will say, because this really, this is this could be a podcast in itself, but all I will say is exactly what This is exactly what I was talking about. You basically had all these economists from the three big kind of schools of economic theory. You had Harvard, MIT, and the Chicago School of Theory. And they all got together and created this hedge fund because they had spent so much time in their corner desks in their offices thinking about how the markets worked. This goes back to your point about the meme account on Twitter. Like, these guys, when they actually went to run a hedge fund, were like, oh, in the most expensive way in history, I guess our models don't actually take everything into account, and human behavior and herd dynamics are a thing that, like, my calculator in my economics notebook didn't account for. So yeah, just another good example of how an economist, especially those types of economists, should not be that leveraged in the markets.
Do you want a fun LTCM fact, by the way, which is relevant?
Like, always.
So Victor Hagani, who was a partner at LTCM, do you know what he's doing now?
My God, I mean, running another fund? I don't know.
He works on passive investment now.
Okay, let's do a full episode on him. We'll get a psychologist involved in that one. But I mean, this really brings us back to the Fed put, right? Because, LTCM, the government had to step in really quickly. You had these 10 guys that nearly blew up, the US economy. The state stepped in pretty quickly. And I want to talk about the Fed put, which is kind of this name and label that's given to the idea that the Fed will always just automatically save, investors. Because the only reason that the kind of global economy hasn't collapsed already is that the Fed keeps bailing it out. And not explicitly, it doesn't say like, here's a 2008 style bailout, but consistently. 2008, we made like a big deal about that. 2020, again, like, that was just $1 trillion write-off in one day. Silicon Valley Bank, like Jason Calcanis, thank you. And each time the machine kind of this global economy starts to crack, the Fed provides liquidity, backstops the system, and keeps those flows going.
Yeah, it's kind of wild. You probably have people who have worked in the finance industry for coming up on 2 decades now who have like never seen a sustained market downturn, which is kind of nuts. It must have made it a really fucking easy job.
I was literally having dinner. I was having dinner recently at a table full of investors, and someone from outside of the investing world said that. And everyone kind of looked around and they were like, no one here is invested in a down market. And those people are like managing director level. So like, you now have people running entire funds, entire banking systems that don't know what the hell to do if things don't keep going up.
Yeah, well, because they've had the lesson, reinforced endlessly that there is no downside, risk doesn't matter, keep buying. Uncle Jerome is there to save you.
Jay Powell, our favorite Fed banker. So yeah, this whole thing is basically binary. You have the Fed with liquidities, flows, and belief, or you don't. And the entire market reprices, again, code word for it gets fucked up, in days, not months. And I think at this stage, it's not even days, it's hours. Like, look at Silicon Valley. That was a number of hours that, the whole system started to wobble a little bit. So it's not just some fragility, it's this like super dependency on all parts of the system working really well. And we build this market that can't survive without intervention, which means one day when the Fed can't or won't step in, the whole thing will break. I mean, the question really is like, what does that day look like when the Fed can't or won't? But here's where it kind of all comes together. The Fed put the idea that, the Fed will always step in. The pension industry and this kind of passive feedback loop, they've created this monster, something that looks like this booming economy. But then when you touch it or you actually look under the hood, there's nothing there. And this certainly is not a recovery post-COVID. It's like a hologram, right? So it's this kind of market that is built on the illusion of prosperity instead of pricing that is consistent with fundamentals. And in the, as far as it links to the real economy, I mean, it doesn't. The market keeps going up, but productivity in the real world is declining.
That's the Cantillon effect in action, which is those closest to money, the investors, the asset holders, the institutions benefit first, and everyone else just gets the lagged inflation. So while the top decile watches their portfolios grow, everyone else is paying. Sorry, it sounds like Mamdani's election campaign in New York, but everyone else is paying 30% more for groceries and can't buy a home. This is essentially policy-induced inequality.
Yeah, like we sound like real socialists here, which I am not. But I mean, this is really amplified by the financialization of the economy, where capital is increasingly obviously chasing momentum. More and more capital flows into share buybacks. Now I actually sound like Mariana Mazzucato, which I don't love.
Your best friend.
My best friend. These kind of speculative tech bets rather than, real stuff, R&D, factories, or hiring. And you can see this impact clearly in the IPO market, right? Like last year, IPOs were down 75%, which is massive compared to, 2021, which was, a crazy year anyway. But this basically means that like VC is totally fucked, private equity is fucked, and because these companies that they invest in have no exits, like they've no way of, these investors can't get their money back. In this, this has massive impacts on our favorite McKinsey managing partners who aren't getting, the IPO work that they used to. So this basically tells us that like the entire oxygen, even within the financial sector, and I don't mean the real productive part of the economy, but like the part that we think is the least productive, the oxygen is being sucked out of that too.
Yeah, and policymakers sort of still cling to this idea of the wealth effect. It comes from Milton Friedman and Franco Modigliani, which is that rising asset values boost consumer confidence and unlock spending because people feel richer. But this was a theory built by and for people who already had assets. Because, yeah, if you imagine the economy as Friedman did, as this tidy, rational system of utility maximizing agents, ignoring inequality, ignoring power, ignoring the fact that most people don't own shit, or like Modigliani, which I always love, assumed that everyone planned consumption across their lifetime like a spreadsheet. And he just kind of assumes that wage precarity, debt, or didn't really mess with this. But yeah, like, if you take that set of assumptions, the wealth effect might work. But if you're already wealthy and sitting on $2 million stock portfolio and your house just gained 15% in value, yeah, for everyone else, it's a fairy tale. I think 90% of US equity is owned by the top 10%. Like the bottom 50% own about 1%. So asset price inflation doesn't create broad-based prosperity. It camouflages economic decay by pumping capital into the hands of those who already have more than they can spend. And if any of them want to sponsor this podcast, where we can hector them about how unfair it is, they just need to drop us a line.
Wait, did I talk badly about the old people that we want to sponsor this podcast? I did not mean any of it.
You have worked hard for your inflated assets. Thank
Yeah.
you. Thank you for your service.
Yeah, thank you for your service. I will willingly give you all my tax dollars. But really, here's the perverse part. The markets don't need the economy to be strong as we are seeing today. They just need it to not fall apart, right? It just needs to like hang in there, which it's kind of doing at the minute. Because the moment it kind of breaks, the Fed steps in anyway. And when unemployment kind of starts ticking up slowly, everyone starts betting on a rate cut. Last week, I heard talk to chat about the Fed cutting rates again. Although this is like, this is an every quarter, every month thing. Yeah, perversely, bad news becomes good news because it brings more stimulus.
Yeah, I mean, this is the hollow center of the hologram economies, that GDP might be growing, indexes might be rallying, tech firms might be expanding their valuations, but like just reflects who owns the flows. And like the system feels fake because functionally it is.
I mean, I don't want to be Jacinda Ardern.
Out.
The happiness index. I mean, so can I just say, by the way, like, yes, we obviously need to be economically very wary of people's well-being. But can I just also input that the work I was doing in economics at MIT during her presidency was her premiership. She's prime minister, was fascinating. And yeah, it's very interesting that the prime minister that wants to get rid of GDP as an official measure of the economy and replace it with happiness, which is immeasurable, as that GDP also happens to be going down, is a little suspicious.
Yeah, don't they measure gross national happiness in Bhutan, I believe?
I'm not fluent in the macro metrics of Bhutan. They may well do.
Well, I was expecting you to chime in and go, well, I was at a dinner party recently and I was sat next to the former Bhutan Minister of Finance, who now a space investor.
I will hunt this guy down for our next podcast. We'll invite him over.
Yeah.
But yeah, the kind of natural question is, as I mentioned, like what actually breaks this cycle, right? Because the whole system is clearly fucking rigged and over levered and very fragile, as we've described. Like, something has to eventually give. I mean, if you believe this idea of the Fed backstopping the entire global economy, like, are US taxpayers, of which I am one, are we just constantly going to bail out Jason Calcanis over and over again? I mean, like, right now we're in this kind of dream state of, asset prices rising and apparently low volatility and vibes, but like systems like this collapse. We've seen it before many times. It's like, what actually causes that collapse?
Yeah, I think we have to start with the big picture. We are living inside a Minsky supercycle. Minsky's theory of financial instability says that prolonged periods of market calm breed the exact conditions for market chaos because, firstly, people borrow conservatively. Then they start borrowing against future profits. And then you finally hit Ponzi finance, where borrowers can only pay back loans if asset prices keep going up.
Oh my God. Yeah, that's where we
Into
are.
Ponzi territory now. Like, you have companies issuing debt to buy back stock. I'm actually writing, it's not out yet, a Substack piece on an investment firm that's literally doing this. You have retail investors that are trading with margin debt near $700 billion. And yeah, like an entire pension system, as you were talking about earlier, Sinead, that needs 7% annual returns to meet promises decades ago when population was younger and you could get 5% from bonds. And yeah, like maybe we should run through kind of step by step, like what breaks it.
Well, yeah, good idea. But also, we haven't even discussed or mentioned or even talked about, you and I, the EU Commission coming out recently and saying that, firstly, anything the EU Commission says.
Fuck those guys.
But they're great in your idea that retail investors should create that depth in the capital markets, the multi-trillion-dollar depth that the US has that Europe doesn't.
Yeah,
So they
we're
have
doing
made
this.
this. So they have made this call to retail investors in Europe to say, now is your moment to step up and put your well-earned dollars into play with hedge fund managers from the US. I mean, but anyway.
Yeah,
Yes.
I mean, no, we're having the same like fucking dumb thing in the UK at the moment, where the current government thing is like, look at all these UK venture funds whose returns lag not even US passive index linked ETFs, but UK ones. Wouldn't it be great if ordinary people's pensions got allocated more to them? So we're going to bring in a mandatory target. And it's like, give me strength.
Well, Alex, it's not like anything bad can happen when you combine retail investors and venture capital. But again, getting back to how the system breaks, because that is straight on par with things going badly wrong. The first is obviously this kind of liquidity cascade. I mean, if we go back to thinking about what happened in Silicon Valley Bank, right? Number one, liquidity. All of this are kind of passive flows, the Mag 7, the pensions, that relies on the idea that someone is always buying. And obviously, when they stop, kind of think UK gilt crisis in 2022. The Bank of England had to inject billions, like north of £50 billion into bond buying liquidity in 2 days because pension funds couldn't meet collateral calls. Or like the US repo crisis in 2019. Oh my God, very few people actually know about this because this kind of happened right before COVID, which became the much bigger story. But yeah, overnight lending froze and the Fed had to step in with like 80 billion dollars in repo buys by the morning. So like, these are not esoteric moments. They're very much a glimpse into what is gonna happen in the future. It always starts with liquidity drying up.
And then I think the second thing is presumably some kind of volatility shock. And for like the last 5 years, volatility's been artificially suppressed. The VIX, which is the index that measures volatility, has been low. Implied vol is cheap. But as we're doing with more pretentious references to people from the past, as Mandelbrot taught us, volatility doesn't move in a gentle bell curve. It clusters and then erupts. You get an external shock, say, an inflation print that's 0.3% too high, or a surprise war, seems to be getting quite a lot of those at the moment. And then suddenly the hedges fire, the algos trigger, and the machine just eats itself. So we saw a micro version of this in an event, again, has been largely forgotten by people who don't think, an event called Volmageddon in 2018. And it was like often like shorting the VIX was often seen as basically a free way of making money. Due to some mild tremors, a load of inverse ETFs blew up in a single day, wiping out billions. And yeah, it took one afternoon to reveal that half the market was built on short vol trades.
Well, I mean, interesting because, how many wars and inflation prints that are too high or too low do we have at the minute? So, maybe these no longer actually impact anything. But then you have the third thing, which is kind of rate exhaustion. And oh my gosh, so this is kind of, what we're seeing at the minute. We're testing the upper bounds of this kind of debt cycle that we're in at the minute. So, corporate debt north of $10 trillion, household debt $17 trillion. Like, people need to stop buying shit on their credit cards. And the US government debt ceiling alone, I don't even know what it is anymore. Just really, really unfathomably high. But at some point, the system cannot absorb higher rates or roll over the existing debt without triggering this kind of global credit event.
Yeah, I assume this is the scenario where the Fed put starts to crack because, yes, the Fed can cut rates. It can backstop markets, but it can't print energy or print semiconductors or cut rates forever when inflation is sticky. Like, eventually the trade off becomes real. You either have to fight inflation or save the market, and you'll reach a place where you can't do both.
And maybe the break doesn't come from the Fed itself. Maybe it comes from China dumping treasuries, something we've also seen recently, or kind of commercial real estate collapsing, or cyber attack on the rails of global payment companies and infrastructure. But fragile systems don't need necessarily always a big push. They just need some kind of a weird event in the markets. And for some reason, it always happens on a fucking Friday before I'm about to start drinking wine.
Yeah, and it's not always a headline crash. I mean, they often coincide with when I'm on holiday for some reason or about to go on holiday.
My
So in
drinking and
2020,
your holiday is like
yeah,
very
like
inconvenient.
genuinely, sterling tanked in 2022 when I was trying to go to fucking Ireland. Everything became even more violently expensive in Dublin than it already is
Well, could I
because
just
I
say
was
also, President Trump, very, very considerate for his investor friends, like kind of created this skirmish, this kind of short-term war with Iran on a Saturday in the hope that the markets would have been totally fine on the Monday. They were. That was great. He missed the Friday and he missed the Monday.
masterful stuff. Like as Bill Ackman would sycophantically tweet, the art of the deal.
But yeah, like this whole kind of system is what you call this kind of non-linear fragility. Everything looks fine until it doesn't. And we became really good at understanding non-linear economics around COVID. I mean, even thinking about the spread of COVID. But once a feedback loop takes over, it's nearly impossible to kind of stop it. It becomes this force of this life of its own. And that exists also for thinking about when the market goes bad. Everyone runs for the exit. And yeah, there aren't always going to be buyers on the way down to prop up these prices.
And that's presumably we'll see a repricing of everything that's being artificially inflated by easy money, passive flows, belief. Efficient markets hypothesis will be
Ooh.
re-enshrined. Economic actors shall be rational again. Or maybe it's just all fucked forever.
Wow, maybe not. So like, so what is next? It's not kind of in the abstract and not morally, although I feel like we've been on our soapbox a little bit today about quality. But if this whole thing is built on this kind of this belief in liquidity and the Fed, like what happens when one of those disappears?
Yeah, I mean, we are obviously overdue a repricing because, yeah, valuations are stretched, correlations. I mean, the valuations are kind of rough where they were before the dot-com bubble burst. Like, correlations are high, volatility is mispriced, capital is super, super crowded, long meg cap tech, short volatility, leverage beta, private credit in everything. And that loop can only be stretched so far before it reverses.
Yeah, and it's not like we haven't seen this before. I mean, 1994, I think the Fed hiked unexpectedly. Oh my God, it triggered this kind of bond market massacre. Think, what is that prime minister you had for like a day? Liz Truss. Think Liz
But
Truss.
yeah,
I keep forgetting. Was she the cabbage? Was she cabbage?
there's a lettuce, yeah.
Lettuce, okay. Like, think of the lettuce, but like, I mean, this was a massacre unlike any other. And then again in 2000, capital rotated out of this unprofitable growth period and into balance sheets overnight. And 2022, the market finally remembered what a risk-free rate is. And we got, interest rates back again. And $30 trillion in tech lost value nearly immediately. So each time the pattern was kind of the same. You have this high conviction set of trades or investments having been made. Like, add in as much fucking leverage as you can and buying a house, like double mortgage yourself. And then, yeah, a catalyst, it could be anything, but that's going to create this kind of instant shock across the system.
This fragility is really obvious when the average hedge fund has 50 to 70% gross exposure to the same, top 10 US stocks. Retail investors are putting like $90 billion and counting in leveraged ETFs, which this is not financial advice, but those are like dismal products. Please don't buy them, but not advice. The S&P's forward P ratio is 21.1 versus long-term average of 15.5. Use Schiller P ratio, which is my favorite because it's stretched out the earnings over longer. I think it's over 30. Actually, is it over? It's very high. It's higher than 21. And then even like bond equity correlations have flipped, killing the 60-40 safe haven. So yeah, we are not diversified at all.
I mean, can I just ask who is paying their hedge fund manager to put 70% of their portfolio into the top 10 US stocks?
Oh, that's a great business. This is like active management. So much active management. It's just
We're
a scam.
actively managing the S&P.
Yeah. Step one, take sort of S&P weighting, adjust it very slightly. There you go. Just like adjust up the Nvidia and Tesla holding slightly.
I mean, we could do another episode on this, but like most of the time that generates better returns than to really properly actively manage a portfolio. But anyway, we digress there. So getting back to like what actually breaks the system, because it feels like a lot of shit's being thrown at it and still S&P, no sign of it feeling the burn. Yeah, maybe it's an inflation shock, a CPI print that forces J-Pow to hike rates again. I don't know. Like, I don't think we're going to see that. Could be actually a duration mismatch at a pension fund. I mean, like these are infamously all over the place, and like so many funds and even like hedge fund pods have blown up because of this. Maybe it's a run on some sort of tokenized asset that rips through the kind of shadow leverage chain. But like it really doesn't matter because all that you really care about is that liquidity will disappear faster than the belief that the market is stable, and then it's game over.
Yeah, I mean, it was pension funds in the UK that basically undid the whole trust thing in 2022, which was increases in yields on long-dated gilts, basically meant that all these defined benefit schemes using these sort of like liability-driven investments that seemingly none of them fucking understood just were like blowing up left, right, and center. And the Bank of England just had to step in and save them. Like it was absolute carnage. But yeah, on that very cheery note, I think that's basically it. May or may not all be over. I think, yeah, this is why this podcast is not financial advice.
I mean, even if this was advice, what advice would people get from us? It's either really on or it's either really off. Act accordingly. It is tough because like investing into this at the minute is nearly impossible. Yeah, it's really hard to know venture capital, private equity, which asset class is doing well, which industry is going to do well. I mean, AI seems to be the genre du jour for risk capital. But yeah, I mean, like, does it really matter at the end of the day if prices only go up?
I've got lots more interesting emerging markets investment ideas, which you always laugh down. But like, if you'd listen to me on those like Egyptian bonds, which I told you about, yeah, Egypt has not defaulted. You'd have done pretty well. But yeah, I think
we need to start making a macro investment podcast instead of whatever this is. Alex's top tips.
I mean, do you think we could raise some money off the back? Like, just go like, this probably won't make any money, but there's real potential for like outsized returns. We just need to dress it up in like kind of meaningless language.
Well, if any of our listeners want to get involved with Alex and I's new hedge funds, we would be happy, only too happy to take your money.
Yeah, we go like Credit Suisse style and start like messing with like Mozambique's like salmon market or something. But yeah, like
right. On that note, we're going to end it there. We're going to go back to where we started and say, we don't know what the fuck is going on with the markets. Yeah. People are really poor. Well, some people are really poor and the markets seem to be doing extraordinarily well. When I say the markets, I mean, a couple of companies in the S&P 500. So yeah. Who the fuck knows?
Pour one out for price discovery. Rest in power.
Rest in power. I like that. Okay. Until next time. Thanks for listening.
Bye.